Bismillahirrahmanirrahim. Assalamu alaikum dear students and viewers. Welcome to my YouTube channel DigiLearnersPoint. AAR, average rate of return or accounting rate of return, is the topic of today's video. In this video, we are going to explain what is ARR and how it is going to be used. ARR is a capital budgeting technique, rest of the others. So it is different from the rest of the other techniques because the other techniques of capital budgeting uses net cash flows or cash flow streams over the period of project life. But in case of ARR, we typically take into account the profit after the tax or net profit. So, in order to create more significantly or give a more conceptual view in more illustration, I am going to give an example which is a part of an exam question. So, let's start the reading the question. Consider the following two projects: project A, project B, and cost is equal to 150,000 and 150,000 for both the project. The cost is same. Residual value, which is also known as scrap value or terminal value, is 0 and which is also known as closing balance of the investment. So in year 0, which is initial 0 at which you are going to invest in project A and project B amounting to 150,000, same for both the project. So next subsequent preceding years, year 1, year 2, year 3, year 4 and year 5, the cash flow streams are 35,000, 50,000, 60,000, 70,000 and 80,000, and for project B it is 100,000 and 80,000, 60,000, 40,000 and 30,000. Please be notice that if you compare the two projects A and project B, the cash streams or cash inflows from project A in is every year exceeding from the previous years, but in project B the cash flow streams are earning decreases every coming years, 100 to 30,000, from 35,000 to 80,000. So what is the formula of average rate of return, also known as accounting rate of return, is equal to average profit divided by average investment into 100. Average profit for project A is equal to 59,000. How I am going to obtain this one? Sum up all these values, not excluding cost values because it is a cost. I am going to only take into account the cash stream that project A will be produce in the next 5 years respectively. So I am going to show you that if you click on this one, look at this. I have excluded the above figure because it is invested. So look at it, rather 295,000 we have obtained this one. So dividing this by the number of values of years is equal to 5. So 59,000, same procedures apply on the values of 310,000 and divided by 5 we will get the average profit for the project B. Remember, this ARR is only capital budget technique that uses net profit figure, as I have already told you in the beginning of this video. So other techniques are using the net cash flows or cash flows receiving from the projects in their calculation or in formulas, but this technique uses net profit figure in his calculation. Now average investment is equal to initial investment plus terminal value divided by 2, or cost of asset plus installment expense plus terminal value divided by 2 plus working capital. Why I have separate it from the rest of the formula and not divided by 2? Because if working capital is a figure that will be used every month or every year to keep your operating activities in running position. So cost of asset plus installment plus installment expense plus terminal value plus working capital, then working capital. So working capital is here and working capital is here. So we will take it account from working capital. So how many are two working capital divided by 2? So we will get single working capital. So working capital is a common factor. Now I am going to put the values in the formula to get the ARR value for project A and project B. So here is the 59,000 59,000 average profit divided by 150.002. I think something is wrong here. I am going to be divide by 2. Okay. So dividing by 2 because terminal value is equal to 0. No information about the working capital in the question. 75,000. So I am going to be divide this 150,000 by 75,000 and again 150,000 by 70,000. Why it is? Let me check this. F23. Average profit is different from the project A. So due to the difference in average profit, the values of ARR for project B is different. Now you can see that in case of project A, the average return is 79%, and in case of project B, the average rate of return is 83%. Although the investment is same, but in case of project B, the average rate of return is 83%, which is more than project A. So I hope this video will clear you the concept of average rate of return, which is a capital budgeting technique. Thanks for watching. If you have any questions, ask me in comment section, or if you want to add something more from your side, please drop your suggestion with logical arguments in comment section. Thanks for watching. Assalamu alaikum.